Good evening, investors. I'm Nancy Armstrong with the Charlotte chapter in Charlotte, North Carolina, and we extend a warm welcome to you. Also, I know that Research Triangle in the Raleigh area would join us in thanking AAII and Ryan for hosting this webinar. We have over 1,700 attendees tonight, and we owe Jamie Ficino a big shout out. He's with Schwab in Charlotte, and he was instrumental in helping bring Liz Ann and Randy to us. So we're very thankful for you, Jamie. I hope you're here to hear this tonight. Now I'll get right to the reason that we're here, and that's to learn from the experts. Likely, you already know that Liz Ann and Randy are each with Charles Schwab, and full disclosure from me, that's where I've got my investment accounts. Now, I know you want to hear about our speakers. Liz Ann, even though she looks so young, is the Senior Vice President and Chief Investment Strategist with Charles Schwab. She has a range of responsibilities with that title and job description, and one of them is the market analysis and economic analysis and investor education, and that's exactly what we want, investment education. You've likely seen Liz Ann on CNBC, Fox, Bloomberg, CNN, Wall Street Journal, Barron's, and she's Kiplinger's best market strategist and one of Barron's best, most influential women in finance and investment advisor. And investment advisor includes her in its list of the 25 most important people in and around the financial advisory profession. How she's done it all and finds time for us tonight, I am so impressed. Randy is different. He's Vice President of Trading and Derivatives at the Schwab Center for Financial Research. He also focuses on client education and market analysis. Again, exactly what we want to know about, education and analysis. And they know what they're talking about. They've been covering two different investment philosophies for us, and they're here today to make not to make investment recommendations, rather to teach us about the economy and to guide us in a wise investment direction. The rest is up to us, what we do with that information. Now, you and I have the opportunity to chill and enjoy the thrill of learning to be a better decision maker, improving our investment choices that we make. We can discover a lot of better ways from these experts, and that's going to be a joy. Now, if we were in person, I would say join me, and I know that's probably what you're doing anyway, is welcoming Liz Ann Sonders and Randy Frederick. And, oh yes, I forgot. I've got two fun questions that I want to ask them. I'll start with Liz Ann before we give her the whole stage. Liz Ann, why would Ireland be a good investment?
Could it be that the capital is Dublin?
I love it. Good. What else could? What a perfect answer. We'll see if we can stump Randy. Randy, would a skateboard be a good investment?
Well, I haven't skateboarded since I was a teenager, and I used to fall off of it a lot. But I do believe that when you are on a skateboard, one option is that you can flip it.
Oh, I love it. I was expecting totally different answers, but thank you for the fun. No more riddles. All fun aside, it's time to move on. So now I give it to Liz Ann. Thank you, Liz Ann and Randy. Welcome.
Oh, my pleasure. And thank you so much, Nancy, for that fun and kind introduction. And Randy, so Randy and I have done these things in person, in front of the camera, countless times in
Countless times.
my 21 years. And I'm personally disappointed more than just for the obvious reasons that we're not on camera together. Because, Randy, how many times have people made the assumption that we somehow coordinated our outfits when we've done these?
Well, it's a side gig for me to sort of help the other gentlemen with their fashion sense. A sartorial thing is kind of my sideline, but mostly just for fun. But you're right. It has happened before just by coincidence a number of times. And I do apologize for not being able to be on camera. But, these days, sometimes the technology doesn't agree with us. And there's just too many things out there trying to protect us that we just couldn't get it to work. But I wish I was on camera, too, because it would have been a lot more fun. So,
all right, so
we'll just have to do it this way.
Ask you, what color are you wearing, Randy?
Well, I have like a lavender color shirt on, but I am wearing gray pants and I have a gray jacket, which kind of matches the gray sweater I think that you're wearing.
I'm wearing a gray sweater with my lavender grass cloth wallpaper behind me.
Oh, I can't believe it.
Okay. Did it again. And too bad you're not on. So, but anyway, so Randy and I have worked together for a long time, and we're in the same group at Schwab. Called the Asset Allocation Working Group. It's part of, as Nancy mentioned, the financial research arm of Schwab. So we spend a lot of time in communication these days, of course, all through email and in other virtual forms. But what we want to do this evening is really just let you in on what might be a conversation if Randy and I were, sitting at a bar having a glass of wine and shooting the breeze about the market. And we'll try to make it engaging, and I think largely touch on what we both believe are the key issues. I certainly want to get Randy's perspective on areas that he has extraordinary expertise. But I thought maybe the best way to start this is a very big picture overview of this unique year we've all lived through. We had the anniversary yesterday of the market low last year, and just an extraordinary year across all fronts. So I'll just give a very quick high-level overview of how I see the last year, and love to get Randy's thoughts on that too. And then we'll just kind of feed off each other and hopefully touch on the issues that are most top of mind for all of the viewers here. So as mentioned, yesterday was the 1-year anniversary, and depending on how far back you go, which index you look at, it's somewhere in the second or third best single year performance coming off of a market low. And I think that was driven very dominantly by the double-barreled nature of stimulus that we got from the Federal Reserve, where they pulled out many of their tools that they had used during the global financial crisis in the last cycle, including going to 0% interest rates and relaunching quantitative easing. But then a lot of new tools specific for this crisis, some of the backstop lending facilities that they actually announced on March 23rd, which I think helped cement that bottom. It really was a quintessential example of the power of the Fed's words. And then, of course, added to that, which makes the current environment very different than the financial crisis, was massive stimulus on the fiscal side. And the combination of what was done during the heart of the pandemic last year, plus the temporary December kind of fix from a fiscal perspective, and then of course the most recent $1.9 trillion fiscal package, all added up to $5 trillion. You combined what was done by the Fed and what was done on the fiscal side, and it caused a surge in money supply growth to more than 25%. We haven't seen anything like that since World War II. And that really was the launch point for the market. And I view the market since then as having two broad phases. The first one was up until about early September, where the market was doing well, but in a very, very concentrated fashion, really narrow leadership, the big 5 stocks just dominating performance. And that helped to answer the question I was getting a lot last year around why does the market seem so disconnected from the economy? But the reality was, peeling back one layer of the onion, it was connected in the sense that the market was reflecting a very, very narrow group of companies that were not just survivors through the pandemic, but thrivers, and still a tremendous amount of pain more broadly. And then the shift occurred in early fall last year through a combination of hopes for fiscal stimulus, vaccines, and that really saw the market broaden out into more cyclical parts of the economy. And moving into this year, what we have started to see is a bit of speculative fervor, which Randy and I, on multiple sort of avenues of discussing this, will absolutely get to. But that's a key feature to the start of this year, is quite a bit more speculative fervor and excess and sentiment conditions that are, I think, one of the market's more significant risks right now. We're optimistic about the economic outlook. We're going to see some very, very strong numbers. What we don't know is the sustainability of that. And I know we're going to discuss it a little bit more, but that's another area that I think makes this cycle unique, because we can't just put all the pieces together like we typically do coming out of, call it a garden variety recession. There's so much that is unique and unprecedented about this, that we're all flying a little bit blind, even with the benefit of just years and years of history between the two of us. So very broad.
If I could just interrupt you a little bit there, Liz Ann, let me just touch on a little bit on a few of those points you made. So one of the things that I think is really fascinating, as you said, was the big difference between the end of the financial crisis, which had enormous monetary stimulus. This time they added this fiscal stimulus, as you said. But what I found remarkable, one of the things that I've been tracking, as I know we've talked about this since going all the way back to May of last year, was the remarkable similarity between the trajectory of the S&P 500 coming out of the two, even though there was such a dramatic difference in terms of the fiscal policy being added this time. So just to sort of give an illustration of this, the rebound from the market low in 2009, which was just also in March, but only just a couple of weeks sooner than it was this time, by the end of the calendar year last year, on 12/31, the difference in how much the S&P 500 had gained then versus how much it gained last year was less than 1%. It was about 0.5%. And not only did they finish in about the same place, the trajectory and how they got there was virtually identical in almost the entire 9-month period, with two very, very small exceptions. One area being a period throughout the middle of September, and in another period just a little bit towards the end of October. But in both cases, when the two got out of sync, when they diverged, they very quickly reconverged. And as I said, by the end of the year, they stayed in line. I began to sort of notice this correlation in May of last year, and I started talking about it, tweeting about it, and putting it in my normal weekly reports that I've been putting out for well over a decade. So I continued to watch it as this year began, and remarkably, for the first entire month of the year, they were in line again. We had a bit of a divergence in the month of February, but as quickly as they diverged, they went right back together. And where we stand right now, as of the close today, is even remarkable. Again, going to the dead bottom, which was an S&P 500 of 676 on a closing basis back in 2008, to where the S&P 500 was on March 24th of 2010, to where it's at right now relative to the bottom, it is 1% difference. 72.5% then, 73.5% now. So it's remarkable that, okay, maybe it's a coincidence, but my belief is anything that's worked this remarkably well for 14 straight months, coincidence or not, deserves a little respect and deserves to be continued to watch. So question is, well, where do we go from here? If this continues, we're probably looking at, another 7-8% before we go into any sort of meaningful correction, which coincidentally happens to fall right in line with the old adage of sell in May and go away. It's right at the end of May, right at the beginning of May when the correction occurred then, and we could very well be setting up for that now. Anyway, just something I thought was pretty interesting to see how close those two have been correlated. And again, if you follow me on Twitter, you probably see me send these out probably at least once or twice a week. It's just pretty remarkable.
And I think what's also important to remember about coming out of crisis periods is that you also tend to see a lot of what we're seeing right now. You see a move up in yields, you see a move up in inflation expectations, and that's actually fairly normal. I think there's so much focus on this recent increase in yields and just extraordinary concern about inflation. But the reality is, I think the move in yields is more reflective of the improved growth outlook and unquestionably a coming pickup in inflation, but not yet of such grave concern that the move up in yields in and of itself represents some massive risk for the equity market. I think when we saw that pop up a couple of weeks ago, when the 10-year yield first went to above 1.6. I think it was the speed there that was a factor, and also some of the technical conditions around an auction that was going on that day. Where I do think it does have an impact is when yields go up, when interest rates are going up, it tends to put some downward pressure on pockets of the market where valuations are richest. And I'm sure you have some thoughts on that too, Randy.
Yeah, and another thing that is kind of fascinating is that you also see a remarkable similarity in terms of volatility. So one thing that I often remind people is that volatility is a non-directional measure. It means movement, but it doesn't really imply movement in either direction. And often it means you're going to have a lot of movement in both directions. You tend to get some of the biggest single up days you will ever find in some of the worst bear markets. And as you're coming out of it, as people are sort of trying to decide, well, are we really coming out of it, or is this just, what we often call a dead cat bounce or a sucker's rally or whatever other term you want to call it, and you get these enormous up days followed by enormous down days. A remarkable thing that's happened here again for going on now 12 full months, because as you said, yesterday was the anniversary. We have had literally two days that entire time where the VIX is closed below 20. And, that's close to the long-term average, but the long-term average isn't anywhere close to what I would call normal volatility. I tend to look at what's called the mode, which is it's another statistical calculation. It's the normal level or the most common level. That's actually somewhere around 12.5 to 13. So you have elevated levels of concern and uncertainty, and that continues to drive these big up and down days. And I mean, just this week alone, even though it's calmed down to some degree, we've had two pretty sizable up days. And in many cases, you'll have those intraday reversals. Today was a good example. We opened the day fairly strong, and by midday, with a few very minor catalysts, like a little bit of an increase in oil prices, a little bit of a fall off in interest rates, and all of a sudden the market takes a big downturn towards the end of the day. It's likely we're going to continue to see those sorts of things for a while. Until some of this stuff settles out.
I agree. And I think what we're also seeing is an incredible sort of flip-flop action. I know that's not officially a Wall Street technical term, but flip-flop action on a day-to-day basis. And there's several culprits from a sector perspective that tend to be part of this mix, where on a day that you might have financials or energy at the top of the leaderboard, inevitably what's probably at the bottom of the leaderboard will be communication services and technology. And the very next day, you can see a complete mirror image where tech and comm services at the top and energy and financials are at the bottom. And it makes for certainly a trickier environment for investors who like to think about sectors more broadly from a leadership laggard perspective. And here's maybe where we share something that's a bit actionable, even though we're not providing specificity around recommendation here, is one of the themes that I've been talking about in this environment of this rapid sector rotation and some of these higher frequency of flip-flop type action on a day-to-day basis, on a week-to-week basis, is that a lot of investors, or most investors hopefully, should employ disciplines around diversification, which is always important, but also periodic rebalancing. And oftentimes investors will rebalance based on the calendar. They might do it either on their own or through some sort of advisor or some other systematic program. They might do it based on the calendar on, say, a quarter end basis or an annual basis. And we're just saying, to the extent you have the flexibility, maybe have your rebalancing be a bit more volatility based, where you get these moves. Yeah. And you're trimming into where there's strength and you're adding to where there's weakness, and you're staying in gear by effectively reacting to what's going on. And by that, I don't mean, chasing what the hot area is in the last week or two and running away from what's weaker. And I think that's probably a strategy that can be employed versus trying to figure out over the next day or week what the hot sector is going to be.
Yeah, I couldn't agree more. And let me share a few points on that I think are really important. One is that one thing that has changed dramatically in the last couple of years that has made this so much easier and so much more cost efficient to do is that, for the most part, commissions have gone all the way to zero for virtually all equity trades.
We may have had something to do with that at Schwab.
Yeah, we absolutely did. But it's made this so much more easy, because I agree with you. You should never, and I know you say this a lot, and I do too, is that investing isn't about being all in or all out, and it's never about chasing the hot sectors. We should always be in the market, and we should always have some allocation to virtually all of the sectors in the market. But as you see that day-to-day or week-to-week change where, the leader over the last decade has been primarily technology, followed very closely by communication services. But as you see these interest rates creep up, some of these outperformers, higher beta stocks will have a tendency to pull back more quickly. And when people get a little bit nervous about downturns in the market, you'll see a bump up in things like potentially financials as interest rates creep up, or maybe in utilities or some other more defensive names. And by allowing the ability to trade, even as small as one share at a time, or now, frankly, even less than that, if you want to, you can easily scale in and out on a regular basis. Not trying to turn everyone into an active trader, because even though I focus on active traders with my research, the main point that I emphasize regularly is that active trading should never be more than 20% of your portfolio. Every person that's a trader or an investor should always be an investor. So if you're a full investor, you're 100% investor focused. If you're a trader, you're 80% investor focused and 20% trading. But everyone can benefit from these opportunities, as you said, where you get a little bit of a down dip in an area that if you have a long-term focus, hey, there's a chance for me to pick up a couple of shares at a fairly good price. And I do this in a way by just putting a bunch of open limit orders out there all the time. I figure out what price I'd be willing to add a little bit more to one of these sectors, or maybe even a particular individual stock, put a bunch of limit orders out there and just let them sit. They can sit on the books for 60 days before you have to touch them. And likewise, if I want to trim a little, take a little bit off the table, I'll put a bunch of limit sell orders out there above the market, and orders will be firing off all the time. But the neat thing is with the commissions, it's so cost effective to do that now. I hear people complain about the markets and all this and all that, and I tell them, look, I've been in this business for a long time like you have. There's never been a better time to invest for a retail investor than now. Never been cheaper commissions, never been easier executions, more access, more information, tighter markets. It's pretty remarkable, frankly.
It is, and it's always nice to do things like this with you, because you put meat on the bones of a component of something that I always say when I'm talking to investors from a big picture, broad perspective, which is that too many investors, and you certainly know this based on the kinds of questions that we get, and absolutely the kinds of questions that I tend to get from the media. What do you think is going to happen? What's your forecast of what? And that's about what we know. And I always say that successful investors, to be a successful investor, it's not about what you know, meaning what's going to happen in the future. None of us have the ability to predict that, but what we do. It's what we do that defines whether we're successful, not what we know. And what we do is where you always come in with great practical advice, particularly for investors or traders that are a bit more active and are not truly taking a long-term approach. And I think that's really key. And sometimes we get lost, I think, with all this information and get into that mindset of the only way I'm going to be successful if I know what's going to happen. None of us do, and that should not be the basis for investing or even trading.
Right. I mean, if I can't buy at exactly the bottom or at exactly the top, sell out at exactly the top, then I'm never going to succeed. That couldn't be more wrong. As you said, correct. No one has been able to do that successfully. If you've been able to do that even once or twice, you're lucky. What I often say is that you can just get anywhere close to the neighborhood of thinking that we're close to a top or close to a bottom and sell some of your position. I virtually never sell an entire position unless I've just completely tired of that stock. My belief in that company, for whatever reason it was that I got into it, is just completely changed. I got information I didn't have. I'm done. But if I'm investing in something like a sector ETF, I'll probably never, ever leave that position. I might add to it, as we said, when there's an opportunity because the market has dipped a little bit. I may take some off the table. I always do this on an annual basis in December, but lately with the low commissions and as we've been talking about, as we get these gyrations and these sort of rotation between different sectors, there's been so many good opportunities to just nibble away when it dips and to take just shave off little shavings at the top. And I'll even throw another one out there that's kind of fun. There are a lot of people out there who like to trade options, and I don't ever teach people how to speculate with options because you can all learn how to lose money without my help. What I'm trying to do is teach you how to do this in a way that's very effective. So I won't go into options in great detail because I'm passionate about it, but just one simple example. instead of the limit orders that I just mentioned, instead of putting in a buy limit order below the market at a price I'd be willing to buy it at, maybe I sell a put option there, and then I just sit there. Then I'm essentially establishing a limit order, but I'm getting paid to do it. And if nothing happens, great, I still got paid. And if it does, then I ended up buying it at a price I was happy paying it for. Same thing to the upside. Instead of putting a limit order to sell it at a price that I'd be willing to let some of it go, I sell a call option covered up at that price. Same thing. I get paid, and then I just sit tight, and I don't have to do anything. If it gets to that price, great. I sold it at a price I'm more than happy to let it go at, and I got paid a little bit in the meantime. And if it doesn't get there, fine, I got paid anyway. This is the way to use options in a way to boost that annual income on top of whatever dividend income you might be getting. You could, in many cases, if you're averaging 3-4% a year in dividend, you could add at least another 3 or 4% in that just in option premiums, just using that one simple strategy. Now, if you've never done this before, don't jump in both feet and do that now. But if you understand how these things work, this is a way you can do this in a very effective way.
All right, so let's stay on this subject and broaden it out, because there's been so much attention, rightly so, on this new cohort of traders, investors. It was really born out of the pandemic, and it was certainly helped and fueled by zero commissions and fractional shares, or stock slices as we call it. And again, born out of the pandemic, given an era where everybody was becoming used to working digitally, working from home without maybe the boss over your shoulder, the lack of sports and sports betting. It was just a lot
of checks in the mail coming from the government, right?
And stimmy checks, as they're now being called. But what's interesting is that we really started to see that cohort jump to a much larger share of daily trading volume all the way back last summer. It's just where most of their attention was focused was in the same areas within the market that were leadership anyway, in the FANG type stocks, in the big five, whether in the stock area or the options area. It wasn't until this year that we started to see much more activity in sort of more arcane, lesser quality segments of the market, the heavily shorted stocks, the weak balance sheet, the non-profitable tech companies, the penny stocks. So I'd love your thoughts on that. As someone that has worked with and observed the behaviors of active traders, what do you find unique, a sort of a positive that you're seeing with this cohort, or where do you see some of the potential faults and peril for many of those traders who, I know certainly in the case of trading options, many of them probably don't have the level of education that they probably should?
Yeah, so this is kind of where being old and being around a long time is helpful. So I go back to the internet bubble, and I know you remember it well like I did. There was this enormous just avalanche of brand new people into the market, and everybody wanted to buy anything they could get their hands on that had the name .com at the end of it. And frankly, many companies added .com just to get people to pay attention to them. And your cab driver was giving you investment advice, and your hair cutter was giving you investment advice, and all these people were joining these things that the media called trading arcades. The people who were there never called them trading arcades. That was an insulting term. They were trading rooms. And if you've ever seen one of these, and they don't really, I mean, they do exist to some extent, but not like they did back in those days. You'd see a big room, and it would have potentially 50 to 100 maybe or so people in it, mostly a bunch of type A personality, 20 and 30-year-old men who haven't, who are highly profane, jacked up on 45 cups of coffee, and they're trading NASDAQ stocks like crazy on these ECNs, which were relatively new. And there was a lot of inefficiency in the markets where you could at times buy on one ECN and immediately turn around and sell it on a different ECN for a couple of pennies. And all you heard was just these loud rumble of profanities and people screaming at everybody. Well, that eventually graduated to what was called a virtual trading room, which is where I spent 8 years working for Schwab for a subsidiary here in Austin called Cyber Trader, which was called Cyber Corp at the time we bought it. And what they did was they figured out a way to let people do that from home. So essentially they set up a chat room, if you will. That's probably the best way to call it. We called it the communicator, but essentially it was a chat room where all of our clients, and now you've stepped up from a room of 50 to 100 people to a room of something like 8 to 10,000 people. And they're all sitting at home doing this, and they're trading, and they're yelling, and they're cussing, and they're communicating with each other via these texts. And that's when all of these sort of shortcuts, all these little shortcut terms, DKY and ICYMI and all these things that everybody likes to type in came from. And it was a bigger community, and it was virtual. Today, it's the same exact concept, only now you've created a community that has spanned the entire world. People are communicating, whether it's via Twitter, on Reddit, a number of other different chat rooms where now you've got hundreds of thousands in some cases, or even potentially 1 million people doing the same exact sort of thing. It's just on a grander scale. But here's the sad part, Liz Ann, and you know this, you know where I'm going with this. The movie is the same. It's a bigger audience, but it ends the same. It always ends the same. In the end, the people who get excited because they've watched a company, and I won't name names, but you know what companies we're talking about, as you said, lower quality, penny, speculative companies that in many cases their business models have become outdated, where they've gone up 5, 10, 15, 20 fold in no time at all. A lot of people were buying. We all love to hear the stories on the news and on the radio about these people who bought this stock at $10 and then, and now it's at 421 and they've made $21 million, in their mother's basement, But they don't tell you about the 10,000 or 100,000 other people who bought it at 330 and now it's, back to 60, or, it's bounced back to some extent, some of them, but they'll never get it back. And the thing about speculating to that extent is that you can only keep throwing so much money at it until you run out. And that's when it all starts to fizzle. And in many cases, we've seen a lot of those fizzle, and it's mostly just because the money that they've thrown at it has fizzled out. What got worse is that a lot of them were doing it using call options. And while, the thing about call options, what's fascinating is when you look at it and someone explains to you, well, here's how it works, right? I buy this stock at $50. If I can sell it at $60, that's a $10 profit. What is that? That's 20%. That sounds pretty good. But if I bought an option for only $5 and sold it at $6, well, now I've made, an 80% profit for a whole lot less money. Wow, this sounds really easy, but it's not. The tough part about it is when you buy a stock, you only have to get the direction right. When you buy an option, you got to get the direction right. You got to get the magnitude in that direction right, and you got to get the time frame that it's going to take to move that magnitude in that direction in order to be profitable. It has to happen, and it has to happen quickly.
One of the best analogies that I read a few months ago about sports betting versus trading or betting in the options market is that, the more robust the betting is in the sports betting market can change the sort of odds of winning. It doesn't change the outcome. But betting in the options market can actually can contribute to a change in the outcome, and I think that that's an important difference. And I agree. These stories don't tend to end well. So far, I think what we're seeing, if you wanted to use sort of the bubble term, which has become an overly generic label applied to anything that's gone up a lot, but let's use it for argument's sake. I've been saying that if you're going to think of it in bubble terms, I think of it more in micro bubbles, these small subsets of the market where you've inflated these bubbles. And the good news is, at least so far, is we've seen some pricking in these bubbles. And it's not just this year. You can go back to late 2017 into early 2018 when you had the short vol implosion. That was a bubble in volatility and a play on volatility staying low. So you can kind of prick these bubbles, or at least let some of the air out through a process of rotation, which is what we're seeing. And that is very different than circa 2000, when the bubble burst. It was a bubble in the entire market and took the entire thing down with it. There's one other thing I want to say about 2000. We already talked about the comps to 2009 and 2010, which are incredibly valid. There's a lot of comparisons recently to 2002, especially when we recently saw the forward PE on the S&P 500 hit 27, which was the same level it was in 2000. Here's a very important difference between that environment and this environment when it comes to the traditional fundamentals around valuation. Into the peak in 2000, where the S&P hit a PE of 27, both the P and the E were rising. It's just the P price was rising faster than earnings. And we now know with the benefit of hindsight that earnings were rising into a peak in 2000 and then they rolled over. It is the complete opposite case this time. Price has been rising, obviously, but part of the reason why the PE spiked was because of the epic plunge in earnings last year. So you had an implosion in the denominator that caused a short-term spike in the PE. Literally, when the calendar rolled over and we added one additional quarter of 2021 expected earnings into the calculation of P divided by E, that PE dropped immediately to 22.
Comes
and it
way
is
down,
leveled
exactly.
off
Yeah.
because the denominator is now on its way back up. I'm not saying a 22 or 23 forward PE is cheap. It is not. But the way we got to the recent extreme in PEs was very, very different. And at least we have the benefit now of the denominator or earnings doing more of the heavy lifting. Last year was a year characterized by all multiple expansion because the earnings were declining. Now, so far this year, actually, earnings are expanding, and as a result, the PE is declining. And I think that's
Right.
an important difference between then and now.
Indeed, and for the companies that survived the pandemic, and we know most of them did. In fact, many of them came out far better than were expected. Their huge plunge in earnings and in revenues is going to rebound, and in many cases, it already has begun to, or it's possibly rebounding far faster than what was expected. So we talked about, you talked about this earlier, about the correlation between the economy and the markets. Yes, they're correlated, but they don't work together. Generally, the economy, the market tends to move anywhere from about at different times of the cycle from 6 to about 18 months ahead of the economy. So while people couldn't fathom why in the world would we get a 75% rebound last year when companies were hemorrhaging and falling apart, because it wasn't the market wasn't moving up on what was happening then. The market was moving up on what it saw in the future. Investing is optimistic by its very nature, because you don't buy for what you think a stock is going to do today. You buy it strictly because of what you think it's going to do in the future. So it has to be bullish.
And I think it's always important, even in a normal cycle coming out of a recession, where it's more of a garden variety recession, which obviously we're not talking about in this unique period of time. It's really important, especially for investors, to understand the relationship between leading, coincident, and lagging economic indicators, and which indicators fall into which bucket. And importantly, the knowledge that everyone should have that the stock market is in that bucket of leading indicators, but then understanding how they interact. I think it helps put into context what's going on in the market and the economy. And as you know, I always say, Randy, when it comes to economic data and the stock market, better or worse tends to matter more than good or bad with economic data. The market tends to key more off rate of change. And when the data stops getting worse and starts getting better, and because as human beings, it's our nature to think of economic data, whether it's GDP or the unemployment rate or retail sales, human nature to think of it in good versus bad or strong versus weak in a very absolute way. Yet the market cares more about that more subtle rate of change, which is sometimes why investors are tripped up, especially at important inflection points. Because at a bottom in the economy and or the market, they say, or in the economy, boy, I'm not going to feel comfortable investing until the data is much better. And in particular, if the data is a lagging indicator, like say the unemployment rate, and you say, I want to wait till that's improved markedly, you've probably missed a good chunk of
most of it,
the entire bull market.
So
just understanding that relationship is so important.
Yeah, and let me give you one example that I often share when I talk about that factor is that let's draw it down to a very microscopic level, and then you'll understand it. When was the last time you saw a company XYZ report quarterly earnings and they lost $1.50 per share and the stock goes up 10% that day? In a bubble, you would look at that and say that makes no sense whatsoever, but it does, because they were expected to lose $2 a share. And that's a classic example of what you were just talking about. It didn't really matter that they lost money. What mattered was what they made or what they lost relative to the expectations. They went in the right direction. Their loss was smaller, just like the economic data. It was improving It wasn't an absolute good number by any stretch. No company wants to lose money, but if they were expected to do much worse, then the stock rallies. And you've seen the same thing too with a company that has a spectacular profit in a quarter, but they were supposed to be even more spectacular, and it gets crushed. That's a micro example of how economic data on a whole works relative to the market.
So I'm just looking at the time, and I know we promised we wanted to give ample time for Q&A, and inevitably we did not touch on the macro level that is probably top of mind, but that's the benefit of leaving a lot of time for Q&A. We can touch on maybe the things that some of you hoped we would have, and we haven't yet. So I'm now going to turn it over to our fearless moderator, Nancy, and I think she's been looking at questions as they've been coming in, and let's make this the interactive part of the evening here.
Okay. Can you hear me all right?
Absolutely.
Yes.
Okay, great. I do have some really good questions from our AAII chapter people. It says, here's one from Terry Galusha. He says, the value sector has recovered very well over the past year. Is this still the place for future growth, especially the small cap and mid cap sectors?
Okay, I'll start with this, and I'm guessing Randy might have some perspective on it too. And I'm only jumping in because I just wrote about this, a fairly comprehensive report that's posted on Schwab.com just 2 days ago on Monday. You can either go on my Twitter feed back to Monday and click on the link there, or just go on the Insights tab of Schwab.com. All of our research, by the way, is on the public site. So thank you, Nancy, for being a client, but you don't have to be to read our research. And so I think there's some important nuances when you think about the growth versus value debate. And a lot of it is to differentiate between the characteristic of growth and value and then the indexed kind of constituents of growth and value. There's no question, yes, value has done better this year, but a lot of that is because the sectors, two of the sectors that dominate the value indexes have done extraordinarily well in the last 6 months or so, specifically energy and financial. So number one, there's a bit of a chicken and egg argument. There's been so much of a move in financials and energy, which happen to be housed in the value indexes. So as the question is, where the fundamentals driving financial and energy, the driver, and they just happen to be more dominant. And then from a small cap perspective, again, with financials, when they've been in the leadership position, the Russell 2000 value index, which is the small cap value index, that has almost 28% financials versus only 20% just for large cap value. So two value indexes that have a huge difference in terms of the weight to financials. So you get a big move in financials, it is going to be to the great benefit of small cap value because more than a quarter of the index is in that area. Then there's a concept called the value trap. I would put utilities in that category right now. We have an underperform rating on utilities. They're mostly in the value indexes. There's almost none in the growth indexes. But just because utilities are in the value indexes doesn't mean they offer a lot of value. They're actually quite expensive. That doesn't mean they get moved into the growth indexes. They're not growth stocks because they're expensive. They're just expensive value stocks. One other example I'll give, because we've touched on the tech bust. Let's go to after the tech bust was over, October of 2002. S&P had been down at that point 57%, NASDAQ down 78%, NASDAQ 100 down 83%. If you wanted to find deep value, you found it in many of the tech stocks that had gotten absolutely hammered. A lot of them were still in the growth index. In fact, the PE, and this is for S&P growth and value indexes because we've got better data on those. The PE for the tech stocks in the growth index had gotten down to 20. The PE of the tech stocks in the value index back then was 25. So your cheaper stocks were actually in the growth index, not the value index. So I continue to think that the factor or characteristic of value will be well rewarded. I think investors need to have a focus on valuations, making sure you're not paying up too much. I think you want to take a hybrid approach and look for companies that also can display some earnings characteristics, some growth characteristics, but be mindful of what you pay for it. But you can apply that factor-based analysis to sectors of the market that are more housed in the growth indexes and not just in the value index. So I think in particular in this environment of everybody being very passive oriented and index oriented, just be mindful that saying overweight value, or I think value is going to work, you got to look at it more nuanced because of what's represented in the value indexes versus the growth indexes. So I don't know, Randy, if you have some thoughts as well.
Yeah, just a couple of things I'll note is another reason why you see those types of changes, and specifically within energy and financials, is that it's always easier for outperformance when you're starting out at the bottom. So when you look at these, one of the reasons I include in my weekly report that I put out on Fridays a comparison of how each sector is doing year to date versus last year is so you can see the incredible transition. So energy, which is by far the greatest outperformer of the year, up more than 29%, was last year's dead last sector with a loss of 37%. Well, coming out of the basement, it's a whole lot easier to take off and go up when you're at the very bottom, whereas technology, for example, which was up 42% last year, is down about 0.5% this year. It's very difficult to continue to be an outperformer after that sort of a stellar reaction. Financials, very similar. It wasn't the second worst sector last year, but it was the third worst, and only by about 1%, down more than 4%. This year, up about 17%. Obviously, a big component of that is the rise in interest rates, which has an enormous impact on virtually all financials because a large portion of their revenues come from the interest rate spread. The higher the interest rates go, the wider that spread goes, and so their margin increases. And again, they're coming from a very low level. It's one of the problems that people run into when they chase performance. When you start chasing performance, it's kind of like what you were saying about chasing, the good economic data. You're getting to the game way, way, way too late. You've already missed it. The return is already there by the time you jump in, and you're simply setting yourself up for disappointment. It's one of the reasons why we always say at the very least you should be rebalancing your positions to some extent on an annual basis, because this rotation takes place every year. That's not to say that the top performers from one year will always go right to the bottom, but inevitably, and I like to share a chart in one of my presentations that I think you use too that shows the ranking of the sectors over the course of a whole decade. It's very, very rare for any particular sector to be the leader in each for 2 consecutive years. Likewise, it's very unlikely that the bottom sector will be the loser for 2 consecutive years. Those at the bottom tend to start moving up. Those at the top tend to start moving down. And if you do that rebalancing at the end of the year, this is like my favorite thing of all. You're doing exactly what every single investor wants to do. You're buying low and selling high. And you can let the calendar dictate it for you. It's amazing, really.
And the other thing, interestingly, about energy, and I know Nancy was a long answer, we'll get back to the questions, is that another reason why energy moved up so powerfully off the bottom is the earnings profile and outlook for the energy sector is so far above any other sector, triple-digit kind of percentage increases on a quarterly basis. Not because suddenly the energy sector has become a long-term growth, but the earnings were so depressed that the rebound actually gives them those growth characteristics right now, even though they're still largely housed in the value indexes. So, Nancy, you have another one?
Yes, I have. Terry Brady has a 2-part question. He says, first of all, it seems many advisors are hyping value plays in this current market. Your take on these trends? And then part 2, it says there is a lot of chatter about inflation these days affecting market fluctuations. Please remark about tips and other watch list focus for us AAIIRs.
So I think we probably beat the value question.
Yeah, we already answered the first part of that question, I think. So let's just focus on the second one because we haven't touched on that much. Yes. Go ahead.
And I think, our view on inflation is that there's no question we're going to see a pickup in inflation for 2 primary reasons. One, the supply-demand imbalances and some of the supply bottlenecks that we're already seeing affect certain products like semiconductors, which have gotten a lot of attention, even lumber, which is coming into some of the housing statistics. And that will continue, especially on the services side of the economy, as we open back up and you have this mismatch between supply and demand. And then, of course, you have the concept of the base effect, where for many of the traditional inflation metrics on a year-over-year basis, we're going into the period where the comps will be a year ago at a point where the overall economy, not just in the US, but globally, was shut down. So many of those traditional inflation metrics and their component parts had really gone to the floor. So now the percentage increase on a year-over-year basis will be significant. We don't think we face a significant risk of the kind of systemic wage price spiral inflation that we had, say, in the mid to late 70s into the early 1980s. It's just somewhat unlikely to see that again on a systemic long-term basis until or unless we see much less slack in the labor market. And there's still so much slack in the labor market and very little money velocity. Even though money supply growth is up, velocity is weak. The combination of labor slack and lack of velocity suggests that that type of inflation risk is relatively low. But there are strategies for investors who want to kind of hedge against inflation. So Randy, I'll turn it to you for that piece of it.
Yeah, and I won't claim to be an expert on tips. Tips are one product. I think we both usually defer to our colleague Kathy Jones to go into that one in more detail. But I will touch a little bit on the inflation issue. We know, as we talked about, $5 trillion of fiscal stimulus that has come into this market recently. It's almost impossible to do that and not imagine that it would cause at least some sort of inflation. But as you said, one of the key components of inflation that causes big concerns of the type that some people seem to be worried about is wage inflation. But as you said, while we've seen a tremendous rebound, certainly in the labor market with regard to comparisons, from a year ago, but we're nowhere near where we were prior to the pandemic. Inflation rate, unemployment rates are nowhere near where they were. Even on a weekly basis, both new and continuing jobless claims, which is more of a leading indicator, are still 3 times what they were prior to the pandemic. So there's an enormous amount of flexibility in the corporate sector to keep wages down and not really have to worry about trying to retain quality people, because there's plenty of people out there that are willing to come in and take those positions if they need so. So I agree with you. It's almost impossible you won't see at least some inflation, but the type of inflation that some people seem to be talking about, again, going back to, I harken back to when I bought my very first house in the early 1980s and I had a 14% mortgage. That type of Paul Volcker era inflation, I just think is nowhere in sight.
By the way, there is one asset class, broad asset class, that has outperformed inflation every decade since 1900. And you have to use some sort of adjusted benchmarks for asset classes that don't go back that far. But the one asset class, for what it's worth, and we're talking about decades here, not in a year, that has outperformed inflation every decade is U.S. small cap stocks. So for what it's worth, that's had the most consistent performance relative to inflation.
Yeah, and so then take that information and don't go hog wild and say, I need to go out and throw every dollar I've got into small caps. But we do think it's always a good idea to be diversified, and that means you should have some exposure in small caps. And that helps you, because you're not going to buy it at the bottom, and it does, just because it's happened over the course of a decade doesn't mean it's going to perform that way over the next 12 to 24 months. But some exposure is always a good idea.
Yep. Nancy, do we have another one?
Yes. Roy Teramoto, if inflation is increasing, why does gold stay flat or even decrease? Is it not the hedge against inflation that it used to be?
It's not. Gold has actually never been a terribly consistent hedge against inflation. In fact, more recently, the last few cycles, gold has been more of a geopolitical uncertainty hedge than it's been an inflation hedge. And I think, and I know Randy has some thoughts on this, I also think that there's maybe a shiny newer object that's getting some attention. That's
you knew where I was going to go with that, didn't you?
Some of the interest in gold. I think it, broadly starts with a C, maybe specifically starts with a B. So I'm going to turn that one over to you.
You're exactly right, and I think people know what you're talking about. Here's the thing that I always remind people about gold, and I know you've told people this as well, is that, look, gold does not have revenues. Gold does not sell a product. It doesn't have a CEO. It doesn't pay dividends. It doesn't have to file quarterly reports. gold is this thing that has value because people think it has value because it's scarce. I heard someone talk about diamonds, for example. I mean, it's just a shiny rock. I mean, I like diamonds. I have some, you have some, but really it doesn't have a lot of value. There are valuable industrial metals like platinum and others that do have some very, very important uses in the automobile sector, which is an area that I'm passionate about. But you're right. There's a new kid on the block, and it's not so new, but it's new from the perspective of gold's been around for hundreds of years, and it's cryptocurrencies. Cryptocurrencies have garnered a lot of attention because of their meteoric rise. They did have a very heavy rise back in around 2017, and then they kind of crashed and burned. But those who had the patience to hold on have seen a pretty sizable resurgence. And it's not just Bitcoin. It's the thousands and literally thousands of other cryptocurrencies that are out there. And this is a trend that I think is not going away anytime soon. Now, don't take this as an endorsement, again, to sell all of your stocks and go out and buy every cryptocurrency you can get your hand on. That is by no means what we're saying. But in the same sense that maybe over the past decade or two, you felt the need or the desire to own either some physical gold or some gold futures or maybe even gold miners or anything that tracks the metal to some extent, as a small component of your portfolio, maybe 1 to no more than 5%, certainly, of your portfolio, nothing wrong with that. And likewise, I think that's, how you should probably look at some of these other new shiny objects, as you like to call them. But here's the difference. Here's one of the key differences. And again, don't take this as me dumping on Bitcoin, because that's not the case at all. Bitcoin was the first. It was the biggest. It's definitely the biggest. It was a novel idea, and it's got a huge lead in the market that it's in. I could almost draw some parallels between that and Tesla. Tesla's competitors are all closing in, but they're not there yet. Likewise, a lot of the other cryptocurrencies are all aiming to be the next Bitcoin. They're not quite there yet. But it's highly, highly unlikely that the first is the best, because new, smarter people will always come up with a way to make something a little bit better, a little bit more efficient, a little bit easier. And there's a lot of room, I think, for improvement in this whole concept of cryptos. And that's not to say that Bitcoin can't continue to do well. That's certainly a possibility. Bitcoin in itself, in terms of how the computer code, the blockchain code is designed, has a finite number. You could say, in theory, there's a certain finite number of ounces of gold in the earth, probably, and you have to continue to dig deeper and deeper and go to farther and farther flungs of the earth to find it, so it becomes more and more expensive. Similar thing with cryptos. But what Bitcoin doesn't have the ability to do is to keep other people from creating competing cryptos. Gold, on the other hand, I mean, what is there? There's platinum, there's silver, there's palladium, there's a couple of other items out there, but they can't just be fabricated from nothing like cryptocurrencies can. So those are some of the risks that I think, I mean, I could talk for hours on this, because we do talk about it a lot, that it's, I think, important to keep an eye on. So don't take this as me saying it's a bad idea or that you shouldn't touch it, not by any means, but you should sort of view it in much the same way that you have viewed precious metals over the past, and it should be a relatively small sector of your portfolio, if at all. But yes, it's the new kid on the block, and there's almost no way you couldn't argue that some of the luster of gold that has tarnished has moved and gone a different direction for now. That doesn't mean gold's dead, and it may have a rebound someday. There's certainly possible, but there's always something new. And when you start talking about cryptocurrencies, almost on a daily basis, something new is coming out. I mean, we could go into NFTs. I don't even want to talk about that.
Oh, yeah, and hopefully, Nancy, we've now also beaten the Bitcoin horse to death here, to the extent that there were other questions coming in. We couldn't avoid it this time, and I know I sort of brought it up, but
okay. Well, we'll change. We've got a little different topic here. How concerned should we be about the national debt, and what potential impact can it have on equities?
So I knew that question was coming, because it is by far the number one theme of questions that I still get in this environment. So there's so many ways to slice and dice this, and much like Randy said with Bitcoin, I could spend an hour just on this subject. So to the extent we're actually talking about debt and not the deficit, and it's amazing to me how many people conflate the two. And sadly, in my view, how many people in Washington conflate the deficit and debt. And I'm an equal opportunity critic, by the way. I've heard both sides of the aisle conflate the terms. Of course, deficit is the budget deficit, the annual mismatch of what's going in and out, which, by the way, is expected to hit 16% deficit this year, which we haven't seen since World War II era. Debt is a cumulative effect of running budget deficits, or at least federal government debt is a cumulative effect. And federal government debt, depending on how you segment it, based on CBO projections, is expected to go to above 100% of GDP. And of course, that is exclusive of state and local debt, all household sector debt, all corporate sector debt, all financial sector debt, which if you add all that up, it's about 400% of GDP. But in terms of government debt, we don't know if there's some wall that's going to be hit. And in turn, if that is the case, what the implications are. We don't believe this idea that it's inflationary. In fact, a high and rising burden of debt historically, not just in the US, but globally, has put downward pressure on inflation, not upward pressure on inflation. We've been in a dramatically rising debt environment since the mid-1980s, and throughout that period, inflation has been coming steadily down. You can look at Japan, that has 2.5 times the amount of debt as a share of GDP, and they're still fighting to get out of deflation. Now, part of the reason why inflation doesn't tend to erupt is because that high and rising burden of debt, especially when debt growth is faster than economic growth, it in and of itself acts as a wet blanket on growth. It suppresses economic growth, which in turn is why inflation is kept low. So the implication of debt is not some prospective thing, is actually, frankly, an implication with which we've been living. And in fact, if you just look at the last expansion, which a lot of cheering about that having been the longest economic expansion, I'm talking about the one that ended last February when the pandemic hit, it was the longest in history, but it was also the weakest by far in history. And I think one of the reasons for that is this debt burden, because every additional dollar of debt we're adding is generating much less than a dollar of economic growth. And that is a number that is declining. So the implication is one we're living with. We don't yet seem to have many folks in Washington willing to have an adult conversation about this. And if there's one area in DC where there's bipartisan support, is kicking the can down the road on this. So that's a very broad brush for you. And Randy, I'm not sure if you have anything to add on that.
No, the only thing I would add is just, again, the differentiation between the national debt and the budget deficit. To even think about, even talking about potentially, maybe someday paying down the national debt, we have to first reach the point of a balanced budget so that we're stopping adding more to it. Right. That has only happened one time in the last, 30 years? And that was during 1 year under the Bill Clinton administration. Right. So that to me is the first question. The question about the national debt is irrelevant until we can figure out, well, how can we actually balance a budget? And as we've talked about, we're running higher deficits now than we've ever run since World War II. So we're not even close to that. And if anything, we're moving further and further away from it. The one, I think, redeeming quality of all this is the fact that we have historically low interest rates, which makes servicing the interest on that debt that much cheaper, even as it rises. So that also keeps it in check to some extent.
Okay, and I've got the word that we have time for 2 more questions. And the first of them is, do you see continued pressure on the US dollar to the point where we risk imported inflation? In your opinion, are the presentations on moving to one world currency an unlikely scenario? Could it happen? Very possible.
Well, to some degree, there isn't one world currency, but the US dollar as the global monetary standard has been, a force for quite some time. And I don't know if, Randy, you know the exact percent, but I think it's more than 80% of world trade is conducted still in dollars.
It's somewhere between 70 and 80%. I don't know the exact number, but that's about right. Yeah.
And by the way, I don't think we move in a direction where the dollar or another currency grows to a more significant degree such that there's a single currency. I actually think in the other direction, not that the dollar is going to lose its reserve status or lose its monetary standard status, but I think we're heading into an environment where you're going to have several reserve currencies. that to be distinguished from being the global monetary standard. I think there's going to be more cross-border trade and calculations done in more local currency transactions. But that, I think, just the nature of global trade, the power of the dollar in terms of percentage of reserves by foreign central banks and foreign governments suggests the dollar is going to continue to have that power. Now, in terms of the direction of the dollar, we had been until recently very much of the view of a weaker dollar, but several things changed. One, we saw that greater pickup in growth expectations here versus parts of the rest of the world. That gave some support for the dollar. We saw the move up in yields and the steepening of the yield curve. That gave support to the dollar. We've had much more robust fiscal stimulus than much of the rest of the world. That gave a boost to the dollar. And Randy, you may have some thoughts on this. We had an unbelievably crowded trade on the short side of the dollar by institutions and hedge funds in particular, and they've now shifted more to the long side. So there has been that positioning shift that I think gave a lift to the dollar. So I think there's competing forces, but for now we seem to be on a bit of an upward trajectory, which is to the disadvantage of actually S&P earnings, because S&P earnings broadly tend to benefit more from a weaker dollar than a stronger dollar. So that's one example of an implication. Love to hear your thoughts, Randy.
Yeah, so a couple things I would say. As you said, I mean, we've been on a trend for a very long time where less and less global trade is being done in dollars, but it's still by far the largest currency. There are obviously a couple of competing currencies that could potentially take a greater share. I mean, certainly the euro is one, but I think as we saw a few years back, especially with Greece and more recently with the Brexit, it's difficult to get a whole bunch of countries with different cultures and different objectives and different histories to work together. So in many cases, the euro had been threatened. It's probably not quite as much of a threat now as it had been. Certainly China would like to put their currency, the yuan, out as the global currency, but in order to do so, it requires it to be free floating, something they're not anywhere close to being ready to do. In all likelihood, it would go up dramatically and would crush their manufacturing sector, which is something they wouldn't want to see. They like to have the ability to control it. One of the challenges in having a single global currency, and many people believe that could be Bitcoin or something similar over time. First of all, it would have to be a stable currency. Well, I don't either. It would have to be something more stable. No currency could ever manage daily swings of 5 or 10% in a single day. That would wreak havoc on global trade every second. So that couldn't happen. But you're going to have a very difficult time convincing countries to give up their native currency in order to allow some other currency that they have no control over. One of the challenges you run into is, as we've seen with other countries that have struggled, is that they have to inflate themselves out of a recession, and they wouldn't have that ability any longer. And so they're just not going to be willing to give up that level of control. It would have to be forcibly taken from them, which is something I don't think anyone has the political will to try to do. And I include the United States in that sector. We talked about cryptocurrencies earlier. If cryptocurrencies truly do reach a point where they truly do threaten the dollar in a meaningful way, you can bet that the U.S. government isn't going to stand by and watch that happen. They will actively control it to make sure that it doesn't happen. What's more likely to happen is the creation of a government-run cryptocurrency, which is already being actively discussed right now, but it would be one that's much more in line with some of the currencies that are geared towards trying to maintain a very stable value to the dollar. But a single currency, I just do not see that, certainly not in my lifetime.
Okay, and our last question, though I enjoy hearing these wonderful questions from our investors. Gosh, they're so good. But the last question that I can ask is, do you see a wealth tax coming to accompany our income tax?
I don't. And our colleague, Mike Townsend, who's our man in Washington, thinks that maybe not to go as far as saying it's a complete non-starter, but thinks the likelihood is quite low for a couple of reasons. One, just trying to do the calculation, administering it is tricky, but also the fact that in a 50-50 Senate, there are a couple of very key moderates in the Senate who have expressed that they're not in favor of it. So something like that getting passed, even if they tried to put it in as part of budget reconciliation, probably doesn't happen because of those moderates. That's to be obviously distinct from a higher income tax on high earnings or a higher corporate tax. Those are much more likely. We think of wealth tax has a very low likelihood. Randy, your thoughts?
Yeah, no, I totally agree. I mean, it's just so complicated. People complain constantly about how complex our tax system is. Can you imagine if you added that in? How would you value assets that aren't very liquid? It would be really just impossible to do it. I mean, you know, people who collect art or rare coins or valuable automobiles or whatever, I mean, you can put some sort of esoteric value on anything like that. But in reality, if you've ever owned a hard asset that you've tried to sell, you find out very quickly in a very humbling way that it's really only worth whatever you can find somebody to pay you for it. And many times those people are difficult to find and not easy to get a hold of and aren't willing to do it. So, you know, I have this fight every year with the value of my house in Texas because we don't have income tax. We pay enormous property taxes, and the state decides what my house is worth each year, even if I've owned it for 15 years, which I have. And we fight with them every year about that's ridiculous. I couldn't possibly sell this house for that amount. And they say, well, I don't care. So imagine how that would go. I mean, The one thing we have to always remember is that wealth, extreme wealth, will always go to wherever in the world it is treated the best.
Treated best, yes.
And those people have the means to do that. So if we make it too uncomfortable for the very wealthy to be here in this country, they just will leave. And even on a more local basis, people in New York were made uncomfortable and they went to Florida, right? So, but on an international basis, it will always go to where it's treated best. And there are plenty of countries that would love to have them at much lower rates than we're discussing taxing them at here.
Yep.
Okay, I'd like to squeak in this real quick comment before I turn it over to Ryan. We investors are very appreciative of you both taking your valuable time to educate us, and thank you. Sending you a very big virtual applause.
Thank you.
Thank you, Nancy. I did want to thank, of course, Liz Ann, Randy, and all the folks behind the scenes at Schwab who helped make this happen. Of course, also wanted to thank Nancy for moderating tonight's questions, and the Charlotte and Research Triangle chapters of AAII for helping to coordinate tonight's event. For folks watching, links to some of the resources discussed tonight will be sent to your email address tomorrow, along with, of course, the recording of this. We do have upcoming webinars, which you can sign up for at aaii.com/webinars. Liz Ann and Randy, if our members and viewers want to follow you, where can people find you and follow your commentary?
So I'm at Liz Ann Sonders. That's my Twitter handle. No double Z, no triple N, no exclamation point. I've had a lot of copycats or imposters on Twitter. So just at Liz Ann Sonders. And we post everything that we write that's otherwise on schwab.com on Twitter. And then it's just constant stream of stuff, as I know is also the case with Randy. So Randy, your handle?
Yes, so I am also on Twitter. My middle initial is in there because, interestingly enough, there's a Republican politician in South Dakota who has the same name that I do. So my Twitter handle is at Randy A. Frederick. And you can find my research on our website go schwab.com/Randy Frederick, and you'll find a lot of my content there. And as Liz Ann said, we're just two members of a very large research team. All of us have areas of expertise, and we put out massive amounts of content on a daily basis. So if you're looking for it, it's there. And the good thing is, as she said, all of it is available even to people who are not Schwab clients.
Well, thank you so much for all that. I wish I was famous enough to have an imposter on the internet, but with that, I want to thank you both, and I wish everybody this evening good health and good wealth. Good night, everybody.
Good night, everybody.
Thank you, everyone.
Bye. Thank you.